This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, October 14th, Columbus Day at 7:50 Mountain Time. Our note this week was titled Return of the Bond Vigilantes. That was the theme that ran through the market. Was we think we'll have a third major warning that we've reached our fiscal limit, whether that occurs in 2024 as a consequence of the election and the data remaining relatively firm, or it happens in 2025, is contingent upon the labor market to some extent, or to a great extent, actually. But we do think that that's very much inevitable. And that theme runs throughout our discussion of the recent data. We began with a discussion of the resetting of Fed policy rate expectations for 2025. In essence, we've received three strikes that has put the bond market under a great deal of pressure. The first was the benchmark revision to gross domestic income, which indicated that growth was stronger in 23 and has been fairly strong income, that is, in 2024. That was followed by the September payroll report that we do think was an aberration biased by seasonal adjustment factors, but will definitely need to reverse itself in the October report for the bond market to stabilize near term. And then, of course, the third strike was last week's CPI report that showed that the part of CPI that is most likely to be influenced by 7% budget deficits and government direct transfer payments to individuals as a percent of disposable income, 110 basis points above where they were pre-pandemic. That's where you'd expect to see that inflationary impulse. And that's what troubled us about that report last week. We were anticipating it, but nonetheless, confirmation that we're not going to have quite the degree of price stability that we'd had, or disinflation and falling inflation volatility that was a major tailwind for markets from October through last October through May of this year. So we then went on, after discussing the markets and the pressure that the bond market's been under, we went on to discuss what we're calling an election kurtosis. Now, we started by discussing how we had a jump in the MOVE and VIX indices as we got within a month of the election, because both of the indices are based primarily upon 1 month options. And so it shows you that MOVE index is anticipating an 18 basis point move in Treasury yields as a consequence of the election, and VIX something like a 2.5% move in stock prices. A generalized narrative that's developed is Trump is bad for bonds and Harris is bad for stocks. And while we don't think that that's completely off base, we prefer our 2016 analog, where the lowest probability outcome was a Trump victory and Republican sweep, but that had really positive implications for the stock market and very muted implications for the Treasury market. This go around, we've got a couple of negative scenarios. A Trump sweep is viewed as being particularly bad for the bond market. The bond market's in a very different position than it was back in 2016. The level of debt is higher. Deficits are at unprecedented levels for non-wartime or recessionary periods. And obviously a Democratic sweep would mean that tax policy would get reset in such a way that it would be quite negative for the stock market. So we've just got this very negatively skewed range of outcomes. And we think under almost any scenario, we're going to have to deal with government spending being at record levels, again, for non-recessionary or wartime periods in 2025. So there's a reckoning coming, and we just have a negative skew to all these various outcomes. We do think, again, continue to think that the most probable outcome is a Republican sweep. So moving on to our price stability argument, we provided some background for the 40s, 60s, 90s, all those periods, and we are worried about this non-housing services inflation. For 2 years in a row, we had a soft patch in May, June, and July, and then it picked right back up. And we think that the trend is towards higher inflation. It's not quite 1 month is not enough to spook the Fed into changing the recalibration process. We do think we'll get 25 more in November and December, but then they'll likely stop the process unless the unemployment rate is on a clear path to 5%. So the final piece of the note was reviewing a very interesting paper on tax policy and investment in the global economy from the National Bureau of Economic Research that dug deeply into the effects of the Tax Cuts and Jobs Act and showed that it did have a real impact on capital formation. That's going to be the main focus for us from a fiscal policy perspective, is keeping that intact next year. If it's not, then that does deal a little bit of a blow to our view that we're going to be in a capital spending boom this cycle. So that's it for me. Again, if you'd like to get a trial to become a full subscriber, let us know. We're happy to give you one. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.